Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, November 9, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And we had the makings of a down day today, and it was a down day at the end of the day. But the reality is the market had every excuse to stay down or even go down farther, and it neglected to do so. That's the sign of essentially a raging bull market. And the news, if you want to pin the downturn to any kind of news event whatsoever, there was a couple you can pick out today. One was the disparity between the House of Representatives and the Senate, and they can't agree on the tax bill or the tax package. And so eventually they'll come together, but apparently what the hope was is that they were going to get something done this year by Thanksgiving, let's say, and that would change the rules going into 2018. Now the speculation is that we won't get anything complete and enacted until 2019. Who knows what the reality is? Nobody knows what they're going to do. They're incompetent at the end of the day, meaning all the politicians. But what happened was, also, by the way, you had the Nikkei 225 down last night pretty substantially. I think it was down 2, maybe even 3% at one point. I'm not 100% sure, but either way, so that was interesting in and of itself. Back to this market. So nothing changed from the morning session to the afternoon session in terms of the news as it relates to the tax package, but that's what they pin the sell-off on. Who knows what the reason is? The reason doesn't really make any difference. What matters is the market was down and it recovered. And let's talk about the technicals and where we went, because that's all that really matters is the charts, the technicals, and that tells us everything we really need to know about the market. They can have the news and they can stuff it you know where. So here we are in the daily chart. Nothing happened, right? So the SPY was down 78 cents, 1/3% on close. We came down and pierced through or tested the 20-period moving average, and we ricocheted off that level and had a pretty substantial rally from about midday forward. Here's the intraday chart real quick, and if you just count from the high, we had about 10 candles down before the reversal. It's kind of funny how that works. And you can see here we had a gap lower. We tried to rally early, and then they dropped the market and made a turn right around 12:30 or so, 12:40 in the afternoon. And then in typical fashion, they rallied it right into the close for the most part. And when you look at the daily chart, essentially nothing happened. So we're still above all the moving averages. If in fact we did close or do close going forward below the 20-period moving average, that would change the picture a little bit. We would have to get some confirmation, but that would at least get things started if we're going to have any downside activity in this market. But the fact that we had a bounce off that 20 today, pretty substantial one at that, leads me to believe not much is going to happen tomorrow. Fridays are usually a pretty quiet day. We get some activity in the morning, and then we go into what I like to call the Friday float for the remainder of the day after, let's say, 10:30, 11 o'clock in the morning. The market just kind of meanders around and will typically float around into the close. We'll see. Anything's possible. We could get some activity tomorrow. But the reality is we may get another test of these lows over the next couple of days. But if we don't close below the 20-period moving average, then there's no deal on the downside, and the market will continue to grind higher in this uptrend. That's just the way it looks. That's the way I see it. And that's the way, or at least what the charts are telling us today. When we look at the IWM, you can see here we had a nice little downturn also in the IWM today, finishing only down 0.25%, actually less than the SPDR. So we finished stronger than the SPDR finished today, but not by much, so you can't read into that. We did not come down to fill that gap. Where we really did stop essentially was what I call a gap window, which is the upper end of the gap. So it's right here, and that low of this candle was 145.16. I think we came up a couple of pennies short. The low today was 145.28. So we came up a few pennies short, 12 cents short of the actual gap window, and we had a nice rally off that back above the 50-period moving average on a strong close. Not really, I shouldn't say strong close, a strong rally in the IWM, but the close wasn't particularly strong. We didn't close on the highs of the day, but they did rally the market back to close above the 50-period moving average. Now, we'll see over the next couple of days if we come down to fill this gap. This was the stronger level that would determine, or not determine, but that would be essentially a buy area down here at that 144 to 145 area. Filling that gap was really what I was looking for in the IWM, but we didn't do it today. So we'll see what happens over the next couple of days. We may have another retest of today's lows, or at least have an attempt at these lows over the next couple of days. But if that doesn't happen and the market continues to grind higher, that may be all they were able to do on the downside. But certainly, when you look at the IWM and when you look at the transports, which we'll get to in a minute, that certainly was at least the canary in the coal mine for the one-day wonder that we might have seen today. Not much of a canary, not much of a coal mine. Not yet, anyway. So we'll see. We have to see some more activity over the next couple of days. Maybe this was the start of something, but if the close today or the rally in the second half of the day was any indication of what's to come, I'm not really expecting a lot more downside, but we need more evidence. We need the market to just tell us what its intentions are. And right now, it really hasn't tipped its hand one way or the other. 1/3% down in these markets is not anything to hang our hat on, so we need more evidence. When we look at the transports, look where we came today. We came right to the 95.20 area, pierced through it a little bit. Today's low was actually 94.95. So we pierced through the big fat round number of 9,500. And the low of this green candle was 95.15. So you can see what happened. Once they pierced through the low of that green up candle, they rallied right back. And we closed at 95.1750. And that's not an accident or a coincidence. The low of the candle was 95.15. I adjusted the line of this trend line here to 95.15 spot 93. That's the low of the green candle, and you can see today's close just a couple of points above that level. That's not an accident. It's not a coincidence. That's the way it works. They just fought their way back to close above the low of that green candle. A close below the low of this green candle would be negative, and we would likely come down to some of the other levels we discussed last night, which is to fill this gap, and that would also coincide with the 200-period moving average. So there's your next level down. I think this level will most likely hold, at least for now, where we are today in the transports. But if we didn't, the next level down is 93.83 spot 74 is the actual or official gap fill. The 200-period moving average is just below that area. That would also be a significant buy area for the transports if today's close didn't hold. In the big scheme of things, it's not that far away. It's about 130 points away. That's one more big down day in the transports, and that area should hold. And so therefore, anybody that was willing to step in at the first level that we've been talking about, and the reason why this level was extremely important is you had some consolidation, you had a breakout. Markets like to come back and check in at former breakout areas, and this is the low of the green candle, the breakout candle, and this is common and normal market behavior. Under normal conditions, the market did exactly what we discussed that it was likely going to do, which is come back and check in at the former breakout area, and that's where we closed the day. We came down early, we tried to rally a little bit, but this is where they closed it, right on the number for the most part. Remember also what we talked about last night. Tomorrow is the 21st day from the pivot top all the way up here, right? The pivot top that we made right up here. Tomorrow is day number 21, and we're either going to get a reversal on day number 21, most likely. We're going to get one more flush lower, and if we do, it likely comes down to fill the gap or close enough. Maybe the 200-period moving average, or we'll get a trend change signal. One way or the other, my expectation is that tomorrow's either going to be an up day, it's going to be one final move lower with maybe a reversal at hand. Something like that is really where my expectations are for the transports. We'll see what happens. We'll talk about it tomorrow night. We'll see if I'm right. But that's my story, and I'm sticking to it. Let's go over to the gold market. Now look what happened in gold. We're finally trying to break the bearish pattern that was developing as the market was keeping the gold market was keeping below, or staying below, pardon me, below the 20 and the 100 period moving averages. Yesterday late we closed above it, and today we stayed above it and are maintaining the level above it. So that tells me that there's likely some more upside. We know where the resistance points were and are. We talked about this last night. You have some overhead resistance here at the next red candle high. You have another red candle high right up here coinciding with the 50 period moving average. And then you have a gap fill at 1303. Those are your levels. We couldn't be short. We couldn't be long. Very difficult in the middle of a range to be long or short. And especially since, remember, we had silver not confirming a bearish pattern in gold. So that had me a little wishy-washy. One way or the other, one was going to catch up to the other. So speaking of that, let's go over to silver. And what do you know? Silver's still stuck in the mud. We were down almost 1% today in silver. So while this is still a bullish pattern from a short-term perspective, we're still diverging somewhat. Gold and silver are diverging from each other. They'll catch up, but one way or the other, either this pattern that should play out to the upside will take over and both gold and silver will move higher, or this bullish pattern will fail and they'll both move lower. Ultimately, the bearish pattern in gold will play out. But right now, I think the bearish pattern, at least temporarily, is off the table until and unless we get back below those moving averages, and then we could certainly see some more downside activity. But it's not 100% clear, and when you don't have a 100% clear picture of what to do in a market, you keep your money in your pocket, because cash is a position. When you're unsure, it's a no trade. And one of the members wanted me to address GDX tonight, so I'm happy to do that. And GDX is interesting because I can make 2 or 3 different cases for GDX. I can make a case, well, I'll just start from here, that this is a down move and it's a bearish pattern contained by the moving averages, would likely have another down move, most likely down to the 21.5 level. You see this pivot low down here? That has GDX written all over it if we have another move down. But here's what you have on the short-term basis. So you're below the moving averages, which is bearish, but you have 2 things going on that I've noticed. Okay, number one is you have this red candle, this down candle. Now, we closed above that red candle on the 6th of November. That's generally a sign of bullish behavior, or at least taking some of the bearishness off the table. A close below a breakdown candle, and any large red candle I consider a breakdown candle, generally means the market wants to trade in the other direction. So that's item number one. And in doing so, you had a big up candle, which generally leads to higher prices, but what we're doing is consolidating inside that big green candle, okay? So you have a big up candle that took out the high, closed above the high of this breakdown candle. That high was 22.87. We closed at 22.91 on the 6th of November. Now, we've been consolidating sideways as a result of that big up candle and consolidating below the 100 and 200 period moving averages. I know this is a lot of stuff, but this is what it is. So we had an up move, and now we're basically just consolidating inside this up move, and this will generally want to trade higher. And if that's the case, we'll get above the moving averages. But it's not clear. I wouldn't necessarily be long GDX because it's not a clear picture. There's too many other things. I can build a case for the bearish picture. I can build a case for the bullish picture. And when that happens, I just don't want to take the risk. It's not, in my mind, a 70 or 80% probability that we're going to trade higher. It's more like a 50-50. We could stay below the moving averages, we can trade back down, or we could certainly take a cue from the large green up candle, consolidate for another day or 2 or 3, and trade higher, get above the moving averages, and then have a spike higher. But I don't have a high probability trade one way or the other in GDX, so again, I'm just prone to do nothing with a chart like this. But there's the picture as I see it with GDX. Crude oil. Crude continues to consolidate after the overbought condition. We're basically just going sideways here. You'll go back and forth. You'll go up and down. I still think you're going to come down to test the 55.92 level, possibly even lower, but at a minimum, come down to test the 55.92 level. Whether it happens, I said maybe it'll happen overnight, maybe it'll happen today. It didn't. Maybe it'll happen tomorrow, maybe it'll happen Monday. But one way or the other, as we consolidate, we could consolidate for a week or two, setting up or building up energy for another push higher. In the midst of that consolidation phase, I think we will come down and test the 55.92. It's just a matter of when. I wouldn't be short for that number, but if we continue to consolidate and we stay above this green candle, here, let me move this over. This green candle low, which is 55.66, as long as we maintain each and every day closing above that level of the green candle low, 55.66, then this is bullish and will likely promote higher prices coming. But I wouldn't be willing to buy into the crude oil market until we got closer to the low of this last green up candle. I may be willing to take a shot at that point if it was, let's say, if we consolidated for a week or so, and at that point we were closer to the low of the green candle. That may be an area I might be willing to take a shot, with a full understanding that we may come down to this consolidation point here before moving higher once again. What we're doing now is working off some of the overbought condition. We're letting price either come down toward or the 20-period moving average come up toward price. Either way, that's what's going on. We're eating time off the clock, letting price come closer to home base, which is the 20-period moving average. That's the way I see it. Bond market. Now, this is interesting. Even with a down stock market today, bonds were selling off and yields were higher. It's generally speaking the other way around. When money comes out of the stock market, and I'm not talking about by the close, I'm talking about the decent sell-off we saw in stocks this morning. Usually when that happens, you see money rush into the bond market, hiding for safety. But that's not really what we saw today. And that goes to show you the power of the charts. So what we did see was the fact that this was resistance to the market yesterday and the day before, and we're continuing to sell off from that resistance point coming in to the 50 and almost touching the 100-period moving average today. Do I think this sell-off is done? Probably not. If it is, and we're just going to consolidate for a while, that's going to tell you higher prices are coming. But I think that based on the fact that we had a very strong up move off the lows from way down here, we likely have to retrace a little bit more of that move. If the bond market was up today while stocks were down, that would have been the reason why bonds were up. But since that didn't happen, the media would just ignore that fact because bonds were selling off along with stocks. They don't have a reason, so they just ignore it. That's just the way that works. And it happens with all those market correlations that they like to make. When they're not correlated together, they just ignore them. Doesn't really matter. The bottom line is we found resistance at the red candle high, the breakdown candle, and we're selling off from that area. Nothing more, nothing less. This has less to do with the bond market and more to do with this is the way charts work. And in the dollar, we were down about 0.33% in the dollar today, but the reality is we're still just moving sideways in this bullish pattern here. So we're in the upper range, right? And all this is essentially a bull flag pattern. Here's your flag. This is this bull flag pattern that will generally play out to the upside. The longer we consolidate, the higher we'll go out of this flag. The market right now, the dollar, is building energy, setting up for another move higher. If we continue to consolidate sideways, you'll see the 20-period moving average move up into price, or you will see price move down into the 20, or both simultaneously. And then at that point, you'll probably find support at the 20-period moving average or home base, and then you'll begin to see the next move higher. That's what I see happening in the dollar. And with that, folks, it's everything I intended to discuss tonight. It's everything I've got. So I'm going to give it a wrap here. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.